Welcome back to Ask Dad. On today's video, we're talking about another fractional real estate investing platform, Arrived.com. Jumping right in, when you go to Arrived, Arrived.com, it brings you to this screen. You have to log in, and let's go ahead and hop up to there. And this is what you see when you log in. There's a few different things. Immediately, you see different properties that Arrived either has available as investments, or they have already invested, or they've already fully funded these. And the way to see that is you can see here in the fund, in the residential fund, which is a pool of properties that you can buy fractional ownership in, they have more shares available. The private credit fund, which is investing in loans that they make to individuals, they still have shares available. And then you start getting into the individual properties. And so for here you have the Monterey, they have 98% funded. The Johnson, you'll find they have these cute little names they've created somehow. I don't know if it's people within the Arrived company that have that or not, but the Johnson is in Northeast Tennessee. That's the city, and it's 88% funded. The Manitoba has 66% funded. The Beatbox, one of their vacation rentals, is not available. You can see it says coming soon. The Landa is fully funded, and it funded 6 days ago. And then you can start scrolling down and you see that most of their properties are funded. Something that I've noticed about Arrived properties is they fund fairly quickly if they seem to be a reasonably good investment. Arrived must have some marketing platform that they're using that these properties just go. That's a good thing, I think, for investors to have a demand for their properties. So when you come into Arrived, what I like about them is it gives you a lot of information about the property. So for example, you have a nice photo set. Their properties all seem to be really nice looking. They seem to be well maintained. You can click through, you can click in and actually see more pieces of the individual properties. All of them seem to be recently refurbished or newer properties in general. It gives you the stats of the property, 4-bedroom, in this case 3-bath. It gives you the square footage, and it tells you when the property was built, 2024. It tells you the purchase price, and it tells you the anticipated rent per month, and it actually gives you these little pop-ups down here so you can see the purchase price. It says the price paid to acquire the property does not include offering fees or cash reserves. Why is that important? Well, it tells you the differential between what they paid for the property and all of the fees that went to fix it up, and we'll see more on that later. The anticipated rent per month is pretty simple. The property leverage, this is if they're using financing or not, if there's a loan on the property, or if it's all owned by investors, and in this case, it is all owned by investors. It does say a refinance candidate here. Now, what that means is Arrived at some point may decide that they want to refinance this property, probably if interest rates go down, and they would distribute some or most of those proceeds to the investors, and then your cash flow would be reduced, but you had what's called a capital event, where you received a bunch of capital, some of the money that you invested, back. Kind of a cool model if it's managed appropriately, also makes it a little bit more risky. You have a map of the area of the property, and then it tells you more information about that specific property. So you can walk through and you can see the different status. The rental status is it's currently listed for rent on Zillow and other major sites. All great information for an investor to know that, number one, this property is not currently occupied by renters, so there won't be any cash flow, but they are actively marketing the property. Scrolling down a little bit more, it tells you details about the market, and then you get some documents. So here it talks about the use of proceeds, the series overview, the risk factors, offering circular, all information that an investor should look through to make sure you understand what it is that you're getting into. And then, of course, you get more into just different details. Going beyond that, Arrived has a tab here that is called Financials. And if you click into Financials and you scroll down a little bit, you'll see what they anticipate the annual returns to be. So, for example, on this property, the annual rent, and this is what they expect the rent to be, is $23,940. The operating financing, legal, and management expenses are expected to be $8,062, and the cash flow is expected to be $15,878 per year. Then they come into the raise amount, and the raise amount in this case is $360,870. The raise is what they gather from investors. You will notice if you come back to the first page, they purchased the property for $344,000. They are raising $360,000. Why is that different? Well, there's costs in putting this out for a syndication or for putting it out to different investors. They have to file certain paperwork. They have to do little maintenance things to the property. They may have a lot of different aspects they do. And if you get into their vacation rentals, you'll notice that the raise amount is much higher than the purchase price because they had to furnish the property and do other steps. Then they give you the anticipated cash flow, and in this case, it's 4.4% return on your money. So if you were to invest $100,000, you would expect to get $4,000 and $4,400 per year back as a return. If you were to put $100 in, you would expect $4 per year back in, or $4.40. So not a ton of money, but it's probably equivalent to what you're getting in a savings account, and that's only the tip of the iceberg. Now, the next piece that you would expect is annual appreciation. Homes historically have appreciated over a number of years. Not every single year. There have been a couple of years where home properties or home prices have gone backwards, especially during the Great Recession. We saw a little bit of it in COVID, but then things took off again and actually went nuts. But historically over time, home prices have appreciated. So in addition to the 4.4% annual cash flow, you do have some appreciation on the property that will benefit you only when the property sells. If they sell the property, then you would receive a portion of that. And then they have this handy investment strategy calculator. And you can come in and say, okay, if my investment amount is $1,000, and you can put in different numbers here. If the annual cash flow is 4.4% and the annual appreciation is 4.5%, we would expect my annualized return, and this I believe takes into account inflation and other factors, would be 8.1%. 8.1% is probably not as good as you could get if you went out and bought your own house and took care of all the maintenance, repairs, all of that, the management. However, you don't have to do any of that. Arrive takes care of everything. They also give you the ability to mess around with it. You can say, well, I don't think that market's going to appreciate more than, let's say, 1.2% per year or 1.1%. My average overall return would be 5.4%. Or if you think the market's going to be hot in that market, you can take it up a little bit and say, well, I think that market will be 8%, giving you an annualized average return or an annualized return of 11.3%. So kind of a cool thing. Keep in mind, this little returns calculator is only as good as the data you put in. If you come in here and you max it out and you say, well, we're going to get this and this, you may end up showing a 19% return, but garbage in, garbage out, meaning you're not going to get anything you're not going to get reliable numbers if you put in data that is just never going to happen. So that is really good information to have, and it's a good planning strategy or a good planning tool to have. They also talk about this being a strategic refinance candidate. You can sometimes, if you want to, refinance a property. They're talking about possibly up to 70% of leverage, meaning if the property is worth $100,000, they would refinance a $70,000 loan that they could then distribute to investors. But it also then carries lower returns. Or lower cash flow, Your returns still could be better because then you're leveraged and you have the benefit of the financing carrying some of the burden, but your returns, your annual cash flow returns are lower. Here, though, you get the specific details of the difference between the purchase price and the property amount. So, or the raise and everything that's owed on the property. So you'll notice there's a couple of differences here. So the purchase price is $344,010. They did $29,200 in property improvements and cash reserves. Cash reserves are important to have on any rental property so that if something goes sideways, you're not going back to investors and asking them for money. Closing costs, offering and holding costs, $22,626. And this talks about what all is included in that. It includes the costs associated with closing on the property, which would be like title fees, and you've got utility transfers and things like that. And then also offering the shares for investment and financing the property alongside or after the closing, which brings everything. Oh, and there's also a one-time fee to arrive of $12,040. So understand there is a cost built into this. There needs to be a hold period because generally you're not going to buy a property for $344,000 and turn around and sell it for $407,000 unless it's a pretty good flip. So they need to hold on to this property for some time, probably 3 to 5 years at least at a minimum, and most likely longer than that. So the equity they raised from investors was $360,000. You'll notice there is about a $47,000 differential here, which means Arrived is holding on to some equity in this property also. That's probably good because it gives them incentive to make sure that this property goes well. Then you see that there's no loan, 0% financing, and of course no interest rate because there is no financing. They offered a IPO of $10 per share. There are 36,087 shares, which if you do the math gives you $360,870. They expect to hold this for 5 to 7 years. They give you some notes on that of what could make a differential on that. And then they do charge an asset management fee quarterly of $516. So again, you could probably make more money if you were to go out and buy a rental property on your own, manage it yourself, take care of maintenance and everything else on yourself. But this is a good way for someone to get in and have exposure to real estate with none of the responsibility. It gives you some additional information at the bottom of the website about Arrive, but then we can come over to performance and see how this property is performing. Now, this property is new, so there's not going to be any data, and unfortunately, you are going into this property with some risk. You have to trust that Arrived knows what they're doing. So at this point in time, I'm simply looking at Arrived as kind of a speculative play. The returns are not phenomenal. The projected returns are not phenomenal, but they could do better. They could outperform, and it's a great way to try out different investing platforms. My experience is limited to a couple of months. At this time, I've only got $301 you can see in this account. I have a single family investment, I have a single family fund investment, and I have a vacation rental investment. Just seeing how they do. The vacation rental is called the Sandbar. I bought 10 shares at $10 a share. They anticipate that it's still worth $10 a share, which gives you the $100 value. On their vacation rentals, it's kind of cool. Well, this is actually a little more history on the property. You can see what dividends have been paid. They've so far been paying out about 3.66% per year annualized, and this hasn't been open for a whole year. The dividends paid have been 3.54%, and that shows you the last few sets of dividends that have been paid on this property. If we were to go into that property, this is the Sandbar, and they've got quite the slick marketing package on this one. They invested $1.124 million in this property in Florida, and it is currently operating as a vacation rental. Interesting, you can see that they bought the property for $835,000, and they have $1.1 million into it, and that's because they did some major renovations on this property, and the hope is that it will operate as a business for quite some time. If we were to go down and take a look at all of the details, again, the purchase price was $835,000. They put in $174,000. There was $72,000 in closing costs, offering and holding costs. And then the sourcing fee for Arrived is $41,000 for a grand total of $1.124 million. There are additional costs on this property where they charge 5% of gross rents as an asset management fee. So the vacation rental properties do carry a much higher expense rate, and they don't necessarily project a larger return on investment. So you do hope that it gets a better return on investment, and historically these have, vacation rentals have, but because there are such heavy costs involved in running a vacation rental, it may be better to buy one of the other lower maintenance, more boring type properties, and you'll get a similar return. One thing I do like that Arrive shows on the vacation rentals is it actually shows the Airbnb listing. If you click on that, it'll take you directly to the listing. You can see what's going on with your property, and you can see what the calendar looks like. Are they booked out or not? And in this particular case, they are booked solid all the way through August almost, and even into September they've got bookings. October starts, and then it looks like it gets a little bit slower after that. You can see what the guests are saying and how the management company is doing. You can see that they're actually getting really good reviews, and it looks like people like staying at the place. So based on that information, it looks like Arrived is doing a good job, and we would expect vacation rental rents to increase over time, just like normal rents do. And since it's in a vacation rental area, as the market stabilizes, this year things have slowed down a little bit, it looked like, on stats that I was seeing before, but as they increase, it looks like you should be able to generate more revenue from those. So when I'm looking at Arrived, I'm looking at different pieces that I can invest in. I do like that their properties sell out quickly. I really have seen that their properties, when they come to market, they start booking out very quickly. And you can see that right now they only have 3 different properties that are open. They have other properties that went days ago. And something that I've noticed on the review that we did about Landa is their properties sat on the market for a long, long time. I've seen properties on there for almost a year. And what you have to wonder is it the marketing strategy that they're using, or is it something else? Are people saying that maybe they're not managing the properties as well as Arrive does, or maybe Arc 7 does? Overall, I've been happy with how Arrived has sold the properties out, how they seem to be maintaining them. The data comes across every month like you're expecting it to. The dividends seem to be like you're expecting them to. When the properties need to be filled up, they seem to actually be able to rent them fairly quickly. And from that aspect, I would say I'm happy with the Arrived investments. The returns on the Arrived investments, especially in today's interest rate market, are not great. You're seeing they're anticipated to be somewhere between 7 and 9% all in once the property's sold. And if you're at 7 to 9%, that's okay. You can get better in the stock market, obviously. And you can get 5% if you look around for a high yield savings account. But at the same time, this also gives you upside potential. If the housing market performs better than you expect, then you would also participate in the upside on that. Knowing that you only have to go in and the shares are $10 a share, you can come in with $100 and buy 10 shares. That makes this affordable for anyone who's able to save a little bit of money, put some money aside from every paycheck. And with it not being liquid, meaning you can't sell it like a stock, you kind of have to stay in, which for savings is sometimes not a bad thing. It means that you can't just have a whim on a purchase, but it also means that you should not invest money in this that you need within the next 5 to 7 years, understanding that's their time frame. You can't sell it. The downside with Arrived is there is no secondary market. With Arc 7, with Landa, there is a market that you can sell your shares off to another investor. With Arrived, once you're in, you're in. So that's my review of Arrived. So far, I've been fairly happy with the investment. Would I recommend someone do it in the right situation? Sure, if you want some exposure to real estate. It's not a bad option. But again, if you need the money, I would not do something like Arrived, because you are stuck once you put your money in for a minimum of 5 to 7 years. Hopefully this video has been helpful to you. If it has, please give us a like down below. If this is the type of content you would like to see more of, please subscribe. And if you know someone who could benefit from this type of content, please share this video. Thanks, and we'll see you on the next one.